post-lunch
Yes,
session.
that is what is the difficult task for the resource person is, particularly when you have post-lunch
No, I
sessions.
can give you positive vibes with regard to that, because day before yesterday I had a post-lunch session, but they were very participative, and perhaps the maximum number of participants, as we have seen in the attendance list, was during that time. So खा
I
पी के हेल्दी
sincerely
होके
hope,
सब आ जाते हैं, खा पी के हेल्दी होके सब आ जाते हैं.
I sincerely hope so.
Yeah, yeah,
And really look forward to the session with every one of you.
yeah. They are joining one by one. Madam, can we just wait for a couple of minutes?
Sure, sir, sure.
Yeah. So I can see till now 45 participants have entered this platform. So good afternoon, everyone. I welcome you all to the third and final technical session of day 3 of this ATAL Academy sponsored 5 days online FDP on emerging financial management and accounting techniques organized by Department of Business Administration, the University of Burdwan. Today we have with us Dr. Shikta Singh as the resource person of this session. Dr. Singh is an associate professor with KIT School of Management, KIT University, Bhubaneswar, Odisha. She holds degrees in MA, MPhil, MBA in finance, and she was awarded her PhD from Utkal University. She has been a visiting faculty member of behavioral finance courses at Xavier Institute of Management, Bhubaneswar, and SSC Pune. Dr. Singh is equally focused on her research work and has 28 articles, 4 book chapters, and a book to her credit. She has also completed 2 projects awarded by RBI. Presently, she is busy coordinating and hosting webinars, online FDPs, and is engaged in developing MOOCs. She is a member of professional bodies like Indian Economic Association, World Leadership Academy, OSRI, and OEA. Presently, she is engaged in a number of consultancy works and research projects as well. With these few words, I welcome Dr. Shikta Singh on this platform. Dr. Singh, over to you.
Thank you so much, sir. Namaskar. And namaskar to all those participants. Dr. Gautam, sir, I can see him. And rest of the participants also. Really a great. It's a. I feel that it is an academic exchange. It is not the other side. Rather, it is the dual side. It's both. Thank you, Abhik sir, for such a lovely introduction. And I would really congratulate Dr. Avik for coming up with such a 5-day wonderful planning of this ATAL FDP program. And the university, particularly VC, Professor N.C. Shah, Pro VC, Professor A. Panigrahi, the Registrar of the University, Dr. D. Mandal, the Dean, Dr. Sar, and HOD, Dr. Pradyum Tripathi, and all the faculty members of Bardhaman University for coming up with such a initiation of conducting a 5-day FDP, which has been sponsored by ATAL AICT Group. But before that, let us have an ice-breaking session. I don't want to venture directly deeper into the technicalities which we have today, and will be next 90 minutes. We are going to develop and further discuss upon that. Very recently, I was attending the Universal Human Value, which also has been a proclamation by the government. And they are thinking that that should be a mandatory across all universities and all over India. So why is it so that suddenly a focus has drifted from a sheer technical into value-oriented zones? May I have few responses before I start? Is that human values have degraded? Do we see that in the hope of achieving or in a hope of getting success, we are losing out on certain kind of components which are related to the behavior? Is it so? Yes, can I have few responses?
Yeah, participants, please. I expect some response. We rather expect some response from your end.
So do you see that there has been a degradation in terms of values? So that is why we are, because till now, we have been taking up our computation of economic growth with GDP as a measurement index. But the qualitative component has been, to some extent, missing out. So in order to fill up the gaps, that is why the gross national happiness index has also taken over a great kind of leverage by the economy at large. So is it that we are proclaiming that we are happy, but when we inherently ask ourselves, there is some kind of insecurity which has affected, which has created a space within ourselves? Yes.
Ma'am, I believe it's about we stand somewhere at 139 or 140 in terms of gross happiness index, but the adjacent neighboring country, Bhutan, not very economically as smart as we are, but they have the guts to be there at point number 1 for so many years on a sustained basis right now, and they Perhaps it's a very classic example where it proves that economy can also be taken care of with taking care of the human values and the happiness at large. I think the materialistic world has changed our mentality in such a way that we are running after the numbers. Technically, today, we live in a world which is governed by numbers. Say, for in our field, how many years of experience you have, how many degrees you have, how many papers you have published, maybe for students, how many friends they do have. So it's all governed by numbers, and I think that is what is creating a serious value. I think it's not about degradation, but it's the society is getting channeled in a wrong way, in a wrong direction.
Exactly, very well stated, Professor Arnab. And yes, that is why the focus has been so much on the quants. The quantitative, the numbers has pushed us to certain extent that every time we are just running in terms of creating a place or a position in the entire existing world. So one of the things that I found most fun learning, and most recently, that is why I started my journey with behavioral finance, as I see that because before with my earlier careers and when I was for some time in Pune, I was working with the KPO with BNY Mendon as an investment banker, and there I found that I see certain kind of old mistakes that I made when I trade in certain portfolios, and I can particularly laugh at the history of myself that who are making those mistakes. So chances are if I went back again into trading and I would still make those mistakes, right? Because mistakes, if I'm not making any sort of mistakes, then it is a part of my errors, then I would be perfectly claimed to be, we as human claim ourselves to be very, very rational. So, but with the sense of behavioral finance, with the ideology of certain information related to the biases which are existing in the financial world, earlier I was not pretty much also believing in those unless and until I myself experienced that. So now the understanding of behavioral dimensions are essential just to know that further, yes, I will make those mistakes. But now I realize, now I understand that what kind of mistakes am I going into. So if you look into the esoteric science of economics or finance, they are somewhat clumsy as far as the quants are concerned. But the coolest thing about behavioral finance is it is neither dismal, and it has a whole lot of practical fun, which we are going to take up. And we are in fact going to learn from the mistakes which we have experienced. I hope many of you also might have experienced or realized those mistakes. And in the future, you might also tend not to come up with those mistakes. So I hope I have structured my presentation in a format of taking you through a bit of the concerns which are pertaining to behavioral finance. And then gradually I will move on into the various forms of anomalies that do exist in realities. And the world or the various corporates have also been affected by these anomalies. So I hope here the participants, they have been familiar with few of these biases. But before that, let me take a quick poll. I can share this. Let me share this chat box first of all with you. All of you, can you please log on to mentimeter.com? Just click on to this, either you can click on to this link or you can directly log on to mentimeter.com. Can you?
if I may say, Dr. Singh has given the link on the chat box. So you can just click over there and log into Mentimeter. Yes, madam, it is coming. Fine.
Okay. So, what attributes do you see in an investor? Just one word, if you can put a note on it.
Save or become as an investor.
I don't see anyone responding. I have started the poll. Means as an investor, what attributes do you see?
One of the attribute is savings. Savings
So
converting
you
it as
can
an
type it
investor.
out over there. Okay, I can see is risk taker, risk averse. Okay. As an investor, attribute saving. Okay, I will say come save for future. Okay. Aggressive. So I see responses coming in. Some mentioning patience, consistent, futuristic, risk taker, to earn. Attribute, long-term goal is attribute. Okay. Okay. So let me close here. Can you just click on to the second link? So have you ever been subject to any form of biases? I think it can reflect on your screen. Have you ever been subject to any form of biases? Either it may be related to investing or while taking any decision for the matter. I hope the poll is reflecting on your screen, everyone.
Madam, on my screen, it is saying the quiz is not open. Please wait for the presenter to activate it.
Okay, but I have already activated it and I have started seeing responses coming.
Okay. There must be
You
some
have
quirky.
written yes and okay, no, okay. So I see 13 responses has come up. So you can also mention in the chat box if you're not able to, 14 responses has come up. So have you ever been subject to any form of biases? Yeah, 15 responses has come up. Okay. So I see most of the responses, I'm closing it. So I see most of the responses favoring into that, yes, there is biases. People are affected by biases. And even though biases exist, so to what extent that makes us realize that one should be or should not be. So the thing of dealing with behavioral finance is that we are expected to behave rationally, isn't it? But something there is a certain sense of irrationality that also peaks upon us. Again, coming to this two thing, what do you see in the first picture and in this my right hand side picture? Any specific differentiation can you notice? Hello? Am I audible?
Yes, madam. Yes.
Yeah. Do you see any difference between these two pictures?
The rational one is a mechanical one. It seems somewhat mechanical.
Okay. Which one is seeming mechanical, ma'am?
Rational one is seems to be a little bit mechanical, which lacks emotion.
So you consider it as picture one or picture two?
Picture one.
So picture one is what?
It is labeled as rational and to me like a mechanical person, which is
Okay.
lacking emotions.
And the second one?
Second one is irrational.
Okay. Any other responses? If we can quickly move. Do you see? Can I see any other apart from ma'am which she stated? Any other response? I hope all of them are not sleeping after lunch.
No, madam. We are looking it.
Okay, so but I think you can very clearly. What is that first sense of picture indicating?
It is clearly mentioned over there in the first rational. It is clearly mentioned, madam.
Okay.
Well, I think it mentions that we cannot have human beings programmed like robots, that they can have a very predictive kind of or a normative kind of a behavior given the circumstances.
So
Whereas human beings, of course, we cannot call them to be irrational, but can jolly well be called as to be more normal in comparison to terming them as irrational.
I'm fully agree with. I'm fully agree with the same, sir, madam. See, in this picture, it is clearly seen. The first one is robot. So robot already there is a
The
system
first
is.
one is not at all a robot, it is a human being. And you can very well see that it is a kind of emotion which is being projected. And the kind of emotion is anger. Anyone, by looking at a first instance, can very well say that is the person is happy or it is
Could you
unhappy
please
or
go
it is
to the
happy.
full screen, madam? Madam, could you please go to full screen?
Yes, I am in the full screen only. I'm with my full screen. I hope.
I don't know why it's too small on my laptop. Maybe some technical error at my part. Maybe. That's sure, madam. Please.
The full screen is not coming. Can you just stop sharing once and reshare?
Okay.
Yeah, that same problem which happens normally, that is happening.
Yeah, this.
Yeah.
Because the picture is not very visible then.
I suppose now it's. Now
Yeah,
it's
it's okay. Still, we have your slides present there.
yeah. So I hope it's full screen now.
Not full screen yet.
Yet not,
This
madam.
time the angry face is visible. Other
Yeah.
preceding in other case, the third slide was visible just before this.
I don't know, sir. Then why is it so? But in my screen, it is showing both the pictures.
Okay. Here it is written. What do you see? System 1 and system 2. That slide is visible.
Okay. And not the pictures?
Not other pictures. That angry face is visible.
We can see slide number 4. where we are talking about system 1 and system 2 of brain.
I'm I am not able to comprehend that. Why is it so? Because the entire slide is with it. Okay. Okay. So what I wanted to state is that human brains, yes, it's operating into two systems, 1 and 2. So the system 1, which you saw, and anyone can very well state that it is a kind of emotion, it's anger, frustration, whatever, and it would require no effort, or rather little effort, in order to find out that what kind of behavior is it being projected. And system 2, where you saw that it is a complex kind of calculation which I had shown in the picture. So the systems 2 was rather more effortful, and it needs a slow thinking. So it requires some mental activities that would be much more looking into complex calculations, and that is why it requires time. So the reason of coming forward with these two opposite sense of behavior in human being, which is backed by system 1 and system 2, where one part of the brain acts like thinking fast and another part of the brain acts like thinking slow. So when it comes to certain events of activities, like to detect a certain number of objects which are closer to you, or to discern a friendliness voice, if a voice is friendly, you can very well make out, or to answer what is the score of 2 plus 1, to drive a bicycle in an empty road, to comprehend a simple sentence. All these mental activities or event, these are automatic, isn't it? So there are certain kind of activities which pertains to system 1, and through this, the brain does not require a complex mode of thinking. So at a glance, one can very well make it out at what is going on. But system 2, which I am speaking about, where it is requiring your brain to be more conscious, more effortful. Say, for instance, to identify the number of blinking arrows in a circle, you need to be very, very mindful. Or to discern the voice of a friend in a crowded room, in a noisy room, again, it will require certain concentration. To control your behavior in a social situation, even if you are in pain, because you need to control your brain, not to take out the emotion. Or to compare the two companies' analysis report, because when analysis work is involved, again, you have to make out effort in terms of taking up the complex decision. So two ways of thinking that exist while we come up with any decision making, and this can be segregated as system 1 and system 2, where system 1 is pretty much fast, it is automatic, it is related to everyday decision. See, you need not think about when you wake up in the morning, then what do you have to do before going to your office? Because that is a part of your everyday decision. But after going to office, if something is planned, that becomes a part of your routine. But in between, you came to know that this is another additional work which you also have to do. That was not a part of the day agenda, but it has been carried out, and it requires effortful, which will require complex decision. Then that part of the routine will indicate the system 2. So Daniel Kahneman, which is considered as the father of behavioral finance, he has taken up the decisions of realizing one into thoughtfulness with rather complex, another being the irrational part of the brain, the subconscious part of the brain, which ends up in making certain amount of mistakes. So where you are not having certain amount of self-control. So that is essential, or that is needed in order to know that. So did behavioral finance came about as a way to explain rationally the irrational behavior of the markets and investors. So how many of you agree to disagree, or rather, in fact, also, how many of you agree to this? Do you consider behavioral finance to come about as a way of explaining rationally the irrational behavior of the market? How many of you agree to this, or how many of you disagree to this? Let me give you an instance before I'm moving out. Today in Washington, I hope everybody might be knowing, Prime Minister Modi had its visit over there, and the reaction of the people were somewhat positive, and it made me is there an echo going on? Hello? Professor Ravik, am I audible? Hello?
Yeah, it is audible. It is clearly audible. You
Yes,
can
sir.
continue, madam. Yeah.
So in that sense, when you find that the kind of response which the Prime Minister received, what will be the implication on him, provided, suppose his receipt from the Washington DC would have been in a negative way, then would it have affected, or it would not have created any form of effect? I'm slowly trying to get into the part, but before that, I need some answers from all of you. Yes, this is simple. I think I hope everyone is aware about Prime Minister's visit to Washington. What would have been the degree of responses if it would have been negative?
Some of the responses are coming up in the chat box.
Okay, sir, could you please help me out, because again, this is a problem with Google Meet.
So they are saying negative effect, partly agree, partly agree.
Okay, thank you, sir, thank you.
Yeah, negative effect. So mixed.
So that means that even if market has certain form of bounded rationality, still then there are certain amount of power, which you can term it as the irrational exuberance, that also affects the market. So claiming, or I'm not negating the standard finance model, which we have been reading out through along. So we are just trying to give a different pretext to our standard finance model, that it is not only the quants, or not only the components which are indexed or which are seen before you, but something that more than that of the irrational exuberance do affects the market. Again, a quick pictures into this. I hope both the cars are visible to all of you. So again, what do you notice
No,
in
the
both?
slide is not changing, madam.
Now which slide is visible?
Slide number 4, system 1, system 2, that one.
I have gone to slide number 10.
Can you mail it to me? Then I will. Can you mail it to me? Then we can share it from our end. Yeah. It has now moved to slide 11.
Okay, sir. Then if I'm keeping it in this mode, then I hope it is visible. When I'm making it in full screen, then it is not moving.
हो सकता है. You go to slide 10, madam. Yeah. Now I guess it will be visible.
Okay, sir. So that is what is again the problem over with.
Yeah. Now it is.
So in this case, what kind of pretext or what conditions can be seen in both of these two pictures? So all of you, if I go back to the generation of, say, 20 years, 25 years back, where the ambassador car was driven, and the other side, you see a full base modern technical page driven car. So as an individual, as a person, what differentiation can you see? Even if the ambassador do not have all those of safety features, the mileage is not that great, the speed is not that great. On the other hand, the modern car with all safety features, the speed, the mileage, name everything, it is here. But can anyone, you can tell me that either the number of deaths or number of accidents, has it seen to be increasing with the more safety features, more advanced features with the vehicle? Where have you
No, ma'am.
seen?
No, it is decreasing.
But I'm talking about the number of accidents. Is the number of accidents increasing or decreasing? Just make a, if you can look into.
Ma'am, the increasing accident is increasing, but the death is decreasing. I think so.
So accidents are increasing. Why is it accidents are increasing? Do you know? Again, if you look into the kind of limitations you have, once we are aware about our limitation, I know that I have a limitation of speed, I know that I have a limitation, the safety features are not with me, then I will drive with full of my consciousness. But the very availability of the safety features drives upon my brain, and that allows me to go for a rash driving, because that inhales within me the kind of overconfidence, isn't it? So it is because I am aware that, okay, these are the features, these are the facility which are available within me, and even if I go wayward, nothing is going to happen, and that ends up in making mistakes. So the point of stating of these two kind of extremities is that when, as an individual, as a decision maker, you are pretty much aware about the background, then you tend to make lesser mistake than that of a situation when it is full of facilities, full of provisions with you, but you are striving to conduct or to make all those kind of mistakes. And that is what is human brain is all about. So that is why, very, very aptly stated by Franklin, that an investor's chief problem and the worst enemy is the investor's himself. Yes, you agree or not? Because if you look into a normal rate trading, what kind of response is being floated in the market? And based upon the response only, eventually we move on either to invest or not to invest. Here you can very well see the pictures that what kind of implication or what kind of news is spread over, and how does it create a deeper impact into the market. So with that pretext, when we are talking about behavioral finance, so this part of the science of finance is looking, or it is addressing into the component of economics, psychology, and finance, and thereby transforming those quants into certain qualitative mechanism. And I will also take you through a questionnaire about how to measure those behavior, and so that we can come up with a convertible research paper. So I hope all of you have understood what does behavioral finance or this part of the discipline indicate. Professor Avik was mentioning that he has already covered about it, so I'm not going deeper into this. So that is why for the last 40 years, standard finance has been into dominance, has been into the play. But gradually, the standard finance has taken its own implications, and there has been certain eventualities of activities through which the traditional finance theories, they have been negated, and it has bring about complex changes in your behavioral performance or behavioral indicators. So EMH is one of those traditional finance model which also everyone is aware of, where you find information floating across in various forms, in weak form, in semi-strong form, and in strong form. But even if all the informations are available with us and there is no degree of change, do you think that decisions related to investing in any portfolio follows a standard model of efficient market? Or can we claim that markets are efficient? Yes, any thought for this?
No, ma'am. Market is not 100% efficient.
So if I have a investment that share prices, all informations are reflecting about a particular investment. So investors can purchase undervalued stock, or they can sell the stock for an inflated price. So in that sense, the risk adjusted excess return, if I take a component of alpha, which cannot be consistent into EMH, so does that mean that is it only the market information which I should be looking into while making the investment? Or there is something else which I should be guided by in principle, so that I can be pretty much aware of what kind of risk I am taking? So which EMH says that I hope we have all taken up, that it is beating the market. And the prices, they follow a random walk theory. But is it that in reality, if you look into this current world or current researches, is it only that the performance of EMH into these stratified layers is going to answer our questions as far as our decision making with respect to investment are concerned? Yes or no? Hello? Professor Avik, can you just check it out in the chat box? Is it yes or no?
No, ma'am.
No has been the first response from Kaustav Roy.
Okay.
We got another response as a no. 2 no's till now.
Okay. So, Professor Costa, means can you say why do you think that EMH?
Yeah, many other no's are coming.
So, why is it so? Why do you think that EMH is not? Hello?
Participants, please respond. I hope you can just unmute and talk.
Ma'am, there are several examples where EMH doesn't hold. One of the best example is the Black Monday, we all know, which happened in 1987. Maybe later on, some of the trading experts later on told that it was due to some trading mistakes. But nonetheless, we cannot avoid the matter of suddenly the stock crash. So this was due to not for any apparent news. There was no apparent prior news, and suddenly the market crashed.
Exactly. So there has been n number of instances. Finance people, they have been also thinking about that the dot-com bubble crash was surely because of image, but actually it was not. Even if you look into the other cases of Soleimani, which I was mentioning right now, I will go through in terms of the trading algorithmic as how quants has been also be a negative factor. So in that case, we'll see that there has been an n number of instances where you would find that the cases pertaining to the behavioral biases are still not existing. Yes, Joydeep Dasgupta, sir, you have raised your hand. Yeah, any question?
Dr. Jaideep Dasgupta, if you have any question, you can just go ahead. Ma'am, I think you can continue.
Okay, sir. So that is why we are taking the essence of treating it with the behavioral finances, that we are treating investors to be normal rather than being rational, because we have limited ourselves to certain self-control, certain nudge, certain biases, certain cognitive errors are there, which are pretty much making us to work upon such decision. That is why the conventional finance theories, be it CAPM, be it EMH, they have been to some extent negated by the other side of the behavioral scientist, those who have seen the efficacies of various behavioral biases, various cognitive biases, which do affect the market. So if you can look into the investors as a roller coaster full of emotions, so while making any kind of survey, you can trigger into all sort of questions, that what kind of trend, what kind of market I watch today. If I wait any longer, I will not make any profit. Why doesn't the bank association have anything to say about this? Enough is enough, I should sell and never look back again. Luckily, I sold everything. What did I say? What it is going on here? So there are multiple of emotions which also do affect the investor's process. So this theory of behavioral finance, it has created an impact of, to some extent, negate the old 40 years traditional finance model of EMH, and they have found many particular instances where you have seen the people, those who are so-called calling as rational people, but from the point of view of behavioral finance, these are substituted to be normal and are backed by the irrational exuberance. So I'm just skipping it out because I would go through those anomalies. So I hope everybody is aware of who is this and the work which he had worked for this, gaining Nobel Prize for this theory of bounded rationality and the nudge effect. And this is a very wonderful book. If you can get through this book and get into the nudge effects, how does it work, then nothing like that. You can use it for your research paper even. And it can have a pretty much showing you a direction of how to conduct or how to take up with the research work. So very often nudge has been a principle of making people realize, even if without their consciousness, that how to make up a decision and to what extent they should move on while they are making a decision. So coming to some of those behavioral biases, which actually human brain is being affected with, some of those cognitive biases like your loss aversion, framing bias, anchoring bias, herding bias, mental accounting, disposition effect, prospects regret theory, overconfidence, self-attribution, hindsight, confirmation. These are some of these biases while we are taking up. And while we are conducting a research, because maybe that we as a part of your behavioral finance does know that what is these basic dimensions, because these dimensions have been found out during this early part of this literature. But after the survey was conducted, certain kind of biases has come up which have seen to be affected in the finance world. For instance, if I look into the loss aversion, so loss aversion is nothing but it is a basic tendency of a human brain that I would rather be happy if I gain 100 rather than losing out 100, isn't it? So that is what a kind of situation where people are having a consciousness in terms of dealing with a loss aversion situation. So this is one. While walking in a road, you find that rupees 100 is lying on the ground and you pocket it and you feel happy about it. While walking on the road, you find rupees 200 and you pocket it, and subsequently you find that someone picks up your pocket and you lose ultimately 100. So which situation do you think will be happier for you? The answer, of course, is situation. Since the slide is in window mode, I think that I have, this is pretty much visible. Full screen would have really created a deeper impact. But in this sense, what we notice, it is because of that human tendency of gaining is rather much more rather than losing out. So there is another form of experience which as an individual you can see that when you invest rupees 100 and sold at a value of 2000, and the same investment has touched a high of say 3000 and now you're trading at say 2000, then the pain for the notional loss of 1000 again will be rather more than the overall gain of the investment. So the reason of taking forth of all this thing creates is that loss aversion is a very, very important and a pertinent framing of mind, which makes human brain of or the pain which is calculated in terms of dealing with the losses and than that of the gains. I hope you might have been government also right now in US as such investing in cryptos are fine. But when it comes to India, the conditions of the market, particularly the investment in WazirX related to Trons and Ethereum, it has spiked up in the very recent moment. But earlier, 2-3 months back, the values has gone down like anything. So in this case, how to avoid this bias? So that is what an asset class would like to perform at a time so that one has a well-diversified portfolio. When you tend to see that you are losing out over Trons and the Bitcoin is making a rise, you start investing in Bitcoin, thereby creating a hedging phenomenon. So this is how portfolios readjustment is done. And through this, we tend to take up the loss aversion principles. Similarly, there are other kind of biases like your mental accounting. So mental accounting, in this case, we are trying to compartmentalize our different kind of expenses into different brackets. That means how we are dividing our entire income into the different groups based upon our requirements, based upon our consumptions. And that is what mental accounting is all about. Let me give you another case pertaining to this mental accounting. So can you have a look into this case?
Yes, ma'am. Yes.
So this is a case of a bathrobe man in a green bathrobe. So the situation is that by the third day of the honeymoon in Las Vegas, the newlyweds has lost their $1,000, which was given to them as a gambling allowance. And for New York and Las Vegas, this is what is a common affair which hotels provided. And that night in the bed, the groom noticed a glowing object on the dresser. And upon inspection, he realized that it was a $5 chip that they had saved as a souvenir. And strangely, the number 17 was flashing on the chip face. And taking into as an omen, he donned his green bathrobe and rushed to the roulette table where he placed the $5 chip on a square marked 17. Sure enough, the ball hit 17, and the 32-1 bet he was paid $175, and he has let his winners ride. But once again, the little ball landed on 17, and it paid him $6,125. And it continued till he has earned 7.5 million. But unfortunately, the floor manager, he intervened and he claimed that the casino don't have that much of money to pay him. So if he is hitting a 17 again. So undoubtedly, the groom took a taxi to a Better Finance casino downtown. And once again, he bet it at all on 17. And again, it fetched him earning $262 million. So aesthetically, he let his millions ride till the moment, again, when the ball fell on 18. And with no money for a taxi, he walked several miles back to the hotel. And when the bride asked that, where were you? He just stated that he was playing roulette. And when she asked, how did you do? The answer was, not bad. I just lost $5. So is it a situation where the groom has lost only $5? Is it so? What error did the man in the green bathrobe make when thinking about the winnings and the ultimate loss? And did he lose only $5? Was the loss only referring to his $5? Or it was something more than that?
Ma'am, there is one response from Shumit Mondal, that is no.
Okay, he has not lost. Then sir, could you please state that why do you say no, that his loss, that he has not lost $5?
Yeah. From Arnab Sen also it was more than $5. That is the response.
It was more than $5, you think so? Exactly. So why do you say such a thing that it is more than the loss which he had made is more than $5? Any kind of logic behind that?
Shumit, if you have an answer, just provide the answer.
Yes, yes. Actually, ma'am, what we can say that at first he gained much more than that. But when he was playing, and he was gaining 7.5 million, and like that. And after that, when the ball struck at 18, and he lost the gained money. So here, I think we can say that he has lost actually, because he uh, he has much money in his hand, but actually at last he lost everything. So I think we should count it as loss.
Okay, okay, sir. Professor Arnab, uh, may I know that why do you say that it is only $5 which you have actually lost? All of you believe that it is over $5 which you have lost? But just think that where from that $5 has come. The $5 was a part of the amount which was from that gambling allowance of 1,000, isn't it? So let me answer that in this case, here he has not updated his reference point. Usually, again, while dealing with such cases, anchoring can be taken as a phenomenon, anchoring bias. So what is that anchoring? So you tend to hold upon to a reference point, and based upon that reference point, you think that if you have lost or you have made a gain. So that is actually a form of representative where you are considering that, okay, this is what is my reference point, and I hold on into that. Maybe I am not aware of the underlying problems, but taking that into a reference point, I go on betting into it. So here, the whole point of view is that the person, he has not updated his reference point for the wealth which he has won. And he has experienced a bias, which in behavioral finance, we call it as a house money effect. So what is this house money effect? That when he felt that the money he had won was not really belonging to him, it was the amount of allowance which was given to him due by the hotel. So as a result, when he lost, then when he was very much content that even if he have lost $5 and you have lost the entire money, but the loss was not his because he had not made a single penny in terms of the investment. So provided he would have made his investment from a hard-earned earning, then the pain would have been rather more rather than that of the loss which I have made out of the $5 which was remaining from the allowance. So that is actually a form of biasness which has indicated in terms of referring to a decision. And why was the bathrobe green? It was just a kind of implication which was stated in the story, nothing more. It is just relating to the currency associated with the greenbacks. That is why, to bring up a correlation with the greenback, which are the currencies, the bathrobe was given to be green. So that is why basically when we are trying to take up a context about the various forms of the behavioral biases which are into existence, be it mental accounting, be it framing effect, that how are things actually framed before, or its anchoring effects. So anchoring means we are holding upon a particular anchor or a reference point, and we are not even realized about what is the underlying fact which the company is going through. And in a hoard of that, we start investing into the company. Let me give you an instance of the National Aluminium Company, NALCO. So its share was at one point of time 75 when the Sensex was steading up at 33,000 points. But in the meantime, the post-budget announcement was done. The Sensex has gone down to 30,000, and so do the share price of NALCO dropped from 75 to 60. So one will start thinking about that since the post-budget market and Sensex had started rallying NALCO. So NALCO is a Navratna company. Again, it will regain back into this investment channels. But in the meantime, one is not aware about that there is a major fundamental change which is affecting NALCO as a PSU. Some kind of internal conflicts is going on, which will keep the price to be depressed for a longer period of time. So in that sense, if the investors, without realizing the underlying problems, what is exactly affecting the company's share, he starts investing, then he is subject to a kind of bias, which we term it as the anchoring bias. So holding up to a reference point is absolutely fine. but holding up to a reference point without having proper awareness about that what are the other factors which also is affecting the share prices, then you end up with making mistake. So that is why the different dimensions of behavioral finance, it is pretty much essential to have a clear understanding on. And taking up all this dimension, what I particularly want to take it up is the anomalies and the various kind of market anomalies which are existing into this nature. And we have taken up further about the various forms of markets which are existing. And we have also stated that why would a market be efficient? And even if the market is efficient, but there are many implications in which you can find that it is not only about the kind of rationality, but there are many irrationality which do have and play over it. So taking further a glance into the various forms of anomalies which do affect a market. So for instance, anomalies are nothing but when you say that there are certain inefficiencies, because already EMH has proven that market, we are saying it is efficient, but various forms of anomalies affecting the market has created a disturbance in this model. So various the researchers, they have used sophisticated technique in order to understand the past stock prices and so as to predict the future. But still then, there has been various types of anomalies in the form of calendar, in the form of technical, in the form of fundamental, which the market has seen. Let me give you one of those instances of how to get over into this. So EMH in a semi-strong form, you can find that the stock prices, they are fully reflecting in terms of the public information. But the stock price change when the traders buy and sell based upon their views of the future prospect of the stock. So the future prospect of the stock would be influenced by the unexpected news announcement. So in that sense, the prices would adjust to the news in terms of three forms of reaction. It can be an efficient market reaction by particular crowd. It can be a delayed reaction where you see that the price partially would adjust to the news information, new news, or there can be an overreaction or a correction. So where the prices over adjust to the new information, but will eventually fall to the appropriate one. So in that sense, here you can see that how new information gets into the market and who is providing those information. Apart from the EMH, apart from the available information, there are certain other factors which is also changing the role as far as the market to be reactive to any news and announcement. I hope you might have also experienced usually companies when it relates to your bad news. Usually when the news are announced, it is during the weekend or it is in the starting of a week. Any bad news related to the performance of the companies, they are announced at the last week of the day or in the first week of the day. Or even if it is related to a post-earning announcement. Why is it so? Have you ever realized why the companies need to announce it in the last day of the week? What could be the reason? The reason is just to stop the overreaction situation in the market. Because any bad news, any kind of negative media response would negatively affect the stock of that company. So when it is declared on a Monday, if stock market will close Saturday, Sunday, the picks will be down. And again, when the market opens up on Monday, it rather than in some places it will show a negative effect, but it will show a recovery rather than that of the news which was called up in Saturdays or Sundays. So that is why there has been a kind of adjustment process which has been limited to the size of the stock market reaction to a post announcement drift, to a post earning, and to test the effect of new information. They have called for an approach which is called as your event study. So let us look how the researcher used this method. It's a very, very another kind of situation. On Friday, May 25th, 2007, the executives of Advanced Medical Optics, they recalled a contact lens solution called as Complete Moisture Plus, the multi-purpose solution. And the Advanced Medical Optics took this voluntary action after the Center for the Disease Control, and they found a link between the solution and a rare cornea infection. So the medical name of this cornea infection is acanthomoeba keratitis, which is termed as AK. And the eye executives, they chose to recall their product even though no evidence was found, and that their manufacturing process introduced the parasite that led to AK. And further, the company's official, they believe that the occurrence of AK were most likely due to the result of the end users who failed to follow safe procedures when installing the contact lenses. And because of this, on next Tuesday, 2007, iShares, which had opened up at 34.37, suddenly crashed 5.83 from Friday closing price. So what does this indicate of? It was because of, is it something which was responsible to the behavior, or was it something which was responsible to the efficient performance of the market? The clear indication indicate that I had plotted based upon this slot plot, which has been indicated that how the factors were more of behavioral rather than that of only wants. So another important kind of preparation which was taken up by this company was to find out the abnormal return, and the expected return was calculated by using a market indices taking into the Nasdaq 100 and S&P 500, and they have taken a abnormal return on a stock to the days relative to the news announcement, where the researcher has assigned the value of 0 to the day of the news announcement. 1 day after the news, the value is assigned as +1. 2 days after the news, the value is assigned as +2. Similarly, 1 day before the news announcement, the value is assigned as -1. So how did the market cause a change as far as the various responses were concerned? So based upon this, I had conducted one of the studies pertaining to those behavioral indices. Let me go through that. I hope I had shared that article yesterday with you. That how do calendar anomalies, they affect this behavioral biases. So when you are referring to the various forms of calendar anomalies, they are indicating the effects called as Monday effect. There are turn of the month effect, turn of the year effect, holiday effect. So these anomalies, they have seen, the market has experienced from time to time, and based upon that, it has reflected upon that how the daily average returns from the S&P 500, they have shown a performance over the years. So the Monday effect is nothing but some cases it has been also termed as weekend effect. So this effect, it describes the tendency of the stock prices where it turns out to be negative, or it is relatively low in comparison to the other days of the stock. So for some unknown reasons, the returns on Monday have been consistently lower than every days of the week. And Monday is the only week with a negative rate of return in the given cases. And this is termed as the occurrence of Monday effect with prices falling down on Monday. Similarly, there are the turn of the month effect as well as turn of the year effect. So in case of the turn of the month effect, you'll find that the tendency of the stock prices would tend to rise on the last trading day of the month and the first 3 trading days of the next month. So in case of this January month, we can indicate that the tendency for small cap stock, they have shown larger returns in January rather than in the rest of the month. Amid the turn of the year market optimism, there is one of those class of securities that can consistently outperform the rest. And if you look into small companies, the stock outperforms the market and other asset classes during the first 2 weeks of January. That is why the phenomenon indicates a kind of change, which is a January effect, showing a positive trend. So January effect has been seen in few companies in terms of raising denoting prices, as well as turn of the year effect has also called for a change in the market, where you see that the effect is due to returns during the whole month of the January or due to the end of the year. This is what was the data which was captured in one of those studies. You can find out that in rest of the years, in comparison to that, the mean difference in January was much more rather than that of rest of the days. And that was considered as the turn of the year effect. So bubbles, crashes, they have shown instances where the market has shown a changes and more of a behavioral or a more of a behavioral analysis rather than that of only being fundamental or technical. And this was surely because of the existence of few of these anomalies which has been existing in nature. So have you ever analyzed that why do calendar effects occur? Or why do calendar anomalies occur? Calendar anomalies, it has seen its reflection in various stock movements, stock prices. What is the reason for those calendar anomalies? Hello? Basically, what are calendar anomalies? How do you find that these have been there for age long, or certain literature, certain work has particularly found this existence in terms of its behavioral changes? Or do these anomalies exist forever? Monday effects, January effects. An interesting study I would also like to mention here is that some buyers have also given an indicator based upon the aspirin effect. And it was clearly seen that the stock prices and the aspirin production, they were inversely related. And that was indicating that when the market is rising, fewer people need aspirin to heal the market induced headaches. So is it so there is a correlation between the market performance and the sale of aspirin, which has impacted or which has reflected on the share values of aspirin? So again, also this needs to be studied about how do certain anomalies persist and what are the effect of those anomalies. Some anomalies, they are permanent. Some anomalies, they are there and they are tending to disappear. If you go by the COVID situation, so lifespan of a virus is hardly 3 to 5 years. You might not see the virus to be epidemic in nature in the next few couple of years. So, but the damage which has been caused by that in terms of its businesses, many studies have been done during this time. So, anomalies are something which are certain kind of inefficiencies which the market has seen, and how these anomalies has affected the decision making of the investors. That can be a very, very essential part of the study. The article which I shared with you was pertaining to the existence of calendar anomalies. How do those anomalies occur? And I had tried to find out that particularly with respect to the S&P's Sensex in the banking and the IT sector. I've taken these two sectors and tried to figure out the effect of seasonality in terms of the calendar anomalies in the stock market. And the findings were there in terms of finding out that what was the attempt to examine the calendar anomalies in the IT and the banking, and what was the impact of Indian stock market, particularly the conditions related to returns and the volatility. And for that, I had undertaken a qualitative, in terms of a quantitative study, the sectors, the type of data which was used was fetched out from the Sensex, that is from the website, that is from secondary data. And the models which were used in order to run the test was GARCH, OLS, and to further go upon technicalities, it has used eGARCH and TGARCH. The study period, it was a study which was done in the pre-recession and the post period 2010 to 19. And the methodology which was used was to compute the daily returns of the index by using the OLS regression of analysis and looking into the various types of anomalies which were treated as a dummy factor as D1, D2, D3, and D4. The article which has been shared with you, you can very well find it out. So I had put up the variables of D1 showing the Monday effect, D2 as a Thursday, D3 was taken as the last day of the previous month, that is the turn of the month effect was indicated, and D4 was taken as the January effect, where I presumed in terms of my hypothesis. So the calendar effect, which was indicating a Monday effect, it was shown a tendency of the market to close lower on Mondays than on Fridays. And many supporters have also claimed that bad news has an effect in terms of closing down to falling low. And that is what is the effect of calendar anomalies into this pricing. And to further study the volatility clustering, the GARCH analysis was done. Usually, this GARCH was done to estimate the volatility of returns of the stock as well as in the bond and the market indices. And the results were framed out. Further, eGARCH was also used, which was taken as an further asymmetry into the GARCH. And for that process, here, the processes which was taken as a lag conditional variance was to go for a GARCH, which was a pre and post conditions, where the value was used for the fluctuation period in case of an asymmetric GARCH. And the T-GACH was used as a volatility clustering, values varying from 0 to 1 with a positive and a negative mean. And along with that, the results indicated that the VanKex has a more volatile returns over the period rather than that of the IT during this period. So the paper very clearly estimates the differences in terms of the use, and it indicates that how the various values, the p-values, you can very well see that which of this effect were more for the BankX and for the ITs. So in my study, I found that the turn of the month effect had a positive statistical significance, and the January effect due to the settlement period in Indian market, and to the also in the March, as you know that the tax month was approaching, so no special explanation was made during this period. And right now, if the same study is conducted, since the tax plan has been again extended till the month of December, so it can show a different kind of effects with various conditional variants. So I would like to suggest that if you can work on this and you can further improvise upon your work by going for that, how do market anomalies affect the stock market and the various indices? What are the role of behavioral biases in terms of decision making? What are the role of emotional biases in the decision making? So this field has n number of emerging areas, and yes, mine, apart from using a traditional finance model, if you go for the behavioral theories, the acceptance of paper is rather more in comparison to a fundamental standard models of finance. So right now, most of the researchers, they have shown amalgamation of introducing the various behavioral dimensions, behavioral component, how do they have an impact into this, so that they can very clearly have an indication to find out the market efficacy. I hope, I don't know that to what extent the participants, if you have been able to, any questions? I'll be sharing few research ideas and tips so that we can further, we have our next session. So
Yeah, so the platform is now open for questioning, I guess, madam.
yes, sir, yes.
Yeah. So participants, if you have any question, any observation, so you can just have an interactive session. We can have the interactive session now. We have time to take 2 questions.
Anyone have carried any research in this area, or it is completely new to this? Can I get few responses?
Yeah, this is Harish Kumar, ma'am. This is
Yes,
very
sir.
new for me.
Yes, sir.
Yeah, after this session, I'm planning to go for write an article on in this area.
Absolutely, sir. So for that is why because of this time, I was not able to cover all those dimensions, because there are, first of all, one needs to aware about all those dimensions which are divided into the cognitive, into the emotional, and the heuristics. So the questionnaire has to be framed in that manner which will capture all those constructs, because these are basically constructs, these are qualitative indicator. If I have to measure the what is the amount of pain which which a investor gets as a result of losing out in the stock market, then I have to bench out certain variables which will measure the kind of pain, or which will measure the kind of loss aversion, or the measure the biases which is in the form of anchoring. So the individual, the stock market, or the investor is not aware that he is being subject to anchoring bias. But if we are able to know that, okay, these are the biases which are existing and it is affecting the finance world. It is not that the finance world is not affected by this. These all biases are pretty much affecting the finance world. So how to overcome all these biases? So there are certain amount of indexes, tools, which can measure this qualitative data. I can capture the market performance. Either it is overreacting to a news or it is underreacting to a news. To what extent media is responsible for creating a bias? You will say that, okay, CEO of a company. I will say that how the CEO of a company is getting affected, or do corporate world get affected by biases? What happened with the case, as in, if you remember, in case of Infosys, when Naren Mutri was the head, the prices of Infosys has spiked up like anything. But later half, the the reason for spiking or down of this shares was, is anyone is aware of the Infosys case? So the study has clearly indicated that the scenario is completely a behavioral one rather than that being a fundamental or financial. So the first step, if you want to move ahead with this, the first step is the realization, the understanding of behavioral biases. So that will pretty much give you a very, very clear idea about pursuing research into this area. So a book by Lucy Arcott and These is a very wonderful book of behavioral finance. If you want to start with, you can very well go with this. And yes, this is in India, at least, this is completely a pretty much new discipline. But always rare work are given opportunity to get it a better hold of when it comes to publication. So if you can reorient in terms of your standard finance model to the behavioral practices, I'm sure that it will fetch you levels rather than that. Yes, ma'am. The low base effects which you mentioned was a part of it, is a kind of your fundamental anomaly only. So fundamental anomaly is one of those factors which also is affecting the market. If I look into the PE ratio, if I look into the low price to earning ratio, the base effect, the neglected stock, or the ratio between the high dividend to your yield. So these are certain fundamental kind of practices which again goes into the companies. So low base effect is surely into, it's a packed picture coming into the behavioral finance. Yes, Professor Sumit, very well stated. If you have any more questions, if you can, means we have to take it up further. And to further, anything one you want to add me on so that I can take it up in the next session? Hello?
I guess there are no further questions from the participants at this moment. Participants, if you have any question or any point for discussion, you can bring it up. I don't find any fresh question on the chat box. So, ma'am, I think we should give them some time to think. We will again interact with them on these things for the next 2 days. We have some resource persons tomorrow, and I should let the participants know that Shikta ma'am will be with us on 25th, the second session. And that coincidentally happens to be the last session of this FDP, because after that we will have the online, that short exam and the valedictorian. So if
So that is why it would be really better off if I get certain insight from the participants. So if there are certain missing points which can be taken up, I would really be happy to come up with that. And I'm sharing a kind of questionnaire which will trigger into the facts of how to go about as a part of your research and how to develop a scale in terms of measuring it.
Okay, ma'am, you share it, you send the mail to me, I will share it with the participants.
Absolutely, sir.
Okay, so ma'am, I think let them think and then let us respond to them. And with your permission, I will share your email ID with them, so that if later on, after going through the matters, if they have any query, then
yes,
so
you
that
can
they
do
can
write to me in
access.
my mail ID.
Exactly.
So,
Exactly. I have told them that I will share the email IDs of all the resource persons after taking their respective permissions. So with this, we come to the end of day 3 of this 5-day FDP. So thank you, Dr. Shikta Singh, for accepting our invitation. And I say on behalf of the department that we are all looking forward for your presentation on day 5.
so thank you so much, sir, for inviting me. I would have been more happy if participants would have answered and they would have been more interactive.
Exactly. A
That would
teacher
have
only wants
served
that.
the purpose of the discussion and would have added more value to it rather than going into a monologue.
Exactly.
So
Some of them have responded. Sonal Ahuja, ma'am, I am a research scholar. I'm looking forward to work
yes,
in
sir, I
this
have read
area.
it.
Yeah. So let's see
Yes, sir.
what the responses are.
So thank you so much, sir, and thank you all.
Yeah. It was our pleasure to host you. Again, we will have such programs together so that we can interact even more.
Thank you, sir. Thank you.
And just before the end of the session, I would just like to remind the participants that tomorrow, instead of the regular starting time at 10 a.m., we will start at 9:30, because the resource person, Professor Abhijit Datto of Sikkim Central University, Professor of Finance of Sikkim Central University, he just requested that he has a meeting from 11 a.m. So we will commence from 9:30 a.m. tomorrow. So the link will be made active from 9:15 a.m. So that's it for today. Thank you, everybody.
Thank you. Thank you, sir.
Thank you, sir.
Welcome.
Thank you, sir. Thank you.
Welcome.
Thank you very much, sir.
Welcome.
Thank you, sir.
Yeah, I hope the resource persons are adding value to your existing knowledge base, participants.
Yes, sir.
Very good. Okay, I'm closing this meeting now.